In part two of the discussion of capital structure, again, let's kind of revise or review where we just came from. Modigliani and Miller basically say that in a perfect capital market, the choices of leverage by management will not affect the cash flows of the company. If it doesn't affect the cash flows of the company, then it cannot affect the value of the firm. So what we're going to look through for this part two is we're going to talk about the impact on the cost of capital itself. So what is a market value balance sheet? Essentially, we find the prices, the current market values of all of the assets that the company has, as well as all of its liabilities. So the total value of all the securities issued is going to be equal to the total value of all of the firm's assets. In a formula, obviously, the market value of equity is the market value of assets minus the market value of debt and other liabilities. Again, value, just to keep repeating myself, value is created by the purchase of profitable assets and investments. It's not created by the use of differing methodology for gathering the money to buy those assets. So let's talk about something referred to as leveraged recapitalization. The company has a capital structure and they want to change that capital structure. In this case, what we're going to do is we're going to borrow money and we're going to use that money either to pay a special dividend or to repurchase some outstanding shares. So this company has 50 million shares at $4 a share. We're going to increase our leverage by borrowing $80 million, and we're going to use those funds to purchase 20 million of its outstanding shares. So we're not doing anything at all with the left-hand side of the balance sheet. The assets of the company really don't change. So what does this look like? Here's the company originally, 200 and 200, right? 50 million shares, $4 a piece. Right after we borrow, here's our $80 million, and we have $80 million worth of debt. Now what we're going to do is take this $80 million in cash, and we're going to buy back some of those shares. So now our equity is going to drop to 120. So now we have 30 million shares, and those 30 million shares are still going to have a value of $4 a share. So let's see what has happened. Again, since nothing has happened to the assets, we've just rearranged who gets paid from the profitability of the company. So thinking back, Modigliani Miller's first proposition again said, look, the equity of a company plus the debt of a company, if they're levered, are exactly equal to the value of the company if it is unlevered, which is exactly equal to the assets of the company. So I think a little bit way to better visualize that is the value of a levered company is exactly equal to the value of an unlevered company. So how does this affect cost of capital? Well, here's our formula. The cost of capital of an unlevered firm, this first ratio here, I've rewritten it below, so I think it's a little easier to follow. The weight or proportion in equity multiplied by the cost, the required return on levered equity, plus the weight of debt times the cost of debt, or the returns to debt, that equals the unlevered cost to the firm. So the cost of capital of a levered equity company equals the cost of capital of the unlevered company plus a premium. So essentially what we do is we solve and do a little algebra here. So the cost of capital of a levered company, a levered equity firm, R sub E here, equals the cost of an unlevered firm plus, and then this is the proportion. This debt divided by equity, right? That's the debt equity ratio. Multiply that by the difference in costs between the unlevered company and the debt. So that gives us, again, a formula, if you will, to calculate the returns for companies as they borrow money. So if you think about it, as a company increases its debt, right, as D gets larger relative to E, right, the cost of the levered equity company is going to increase. The cost of shareholder money is going to increase as you borrow more money. So again, if we come back to the previous example that we were talking about, right, the R sub U, right, this is the cost of an unlevered company. We got 15% that return. Here is the debt ratio multiplied by the premium here. That gives us the same 25% that we talked about earlier. So again, the cost, the weighted average cost of capital of an unlevered company is exactly equal to the unlevered or the cost or the return of a company that has no leverage or has leverage. Again, this is just kind of, we're just repeating ourselves over and over and over again. But the point is, we have to understand what is happening to these costs when you move to a cost that is less expensive, such as debt. All right, as we said earlier, even though debt is risk-free, the cost of equity still increases. And essentially what this, I guess, a moral of the story is that as we change back and forth here, the cost of capital doesn't change itself. So if the cost of financing doesn't change, then the cost of gathering funds obviously doesn't change, and the value of the company will not change. So graphically, if we plug in some actual numbers, change the debt and equity, do the formulas and the calculations, right? What we find out is it says, look, the weighted average cost of capital never changes. Go straight across, no matter what you do to debt, there won't be a change in this cost of financing. So with no debt, the weighted average cost of capital is exactly equal to the equity cost of capital. As you borrow money at the low cost of capital for debt, the equity cost of capital rises. It rises because it is more risky. So the net effect, though, is that the firm's weighted average cost of capital is unchanged. So again, I think it's a little bit confusing maybe, but essentially what we're saying here is, look, is that if nothing changes, how can the price change, right? If there's no change in assets, if there's no change in the cost of financing, then there cannot possibly be a change in value from making this particular change. So that's the end of part 2 of this chapter on capital structure and perfect markets.